Jim Stephenson, one stock you like at the NWQ Global Equity Income Fund is Citigroup. Stock's down around 16% so far this year. But among the big mega banks, it's actually only doing better than Bank of America. So what's going on specifically with Citigroup that's holding it back?
Well, I think there's been a lot of concerns about just lower interest rates and then earnings momentum at Citigroup. But when we look forward, we see a tremendous ability for Citigroup to not only lower costs, isolate the bad bank within the portfolio, and start to return a lot of capital to shareholders. We think that'll be a big catalyst for them going forward.
And you're also bullish on NTT, that's Nippon Telephone and Telegraph. That stock's up around 20% this year, pays a nice 2.4% dividend yield. And what's surprising to me about that one is the stronger yen has really not hurt it. So tell me why not and what's going to happen, because right now the yen is weakening.
Well, it's a domestically focused company within Japan, so a lot of the exporters in Japan have been hurt by that stronger yen. NTT being domestically focused is actually benefiting. They're also doing a tremendous job of cost cutting. The competitive environment in Japan for the wireless market's been very muted, and they're starting to return a lot of capital to shareholders. That's been favorably viewed by the market.
And you're also bullish on UPS. That stock's done well this year. It's up 15%, pays a nice, I think, 3% yield. Seems like it has everything going for it. You got a stronger consumer, more people are buying online. So it seems like the bull case is pretty clear there. Or am I missing something?
Well, there's been a lot of concerns about UPS as far as threats from Amazon, and that held it back over the last couple of years. They had 2 straight fourth quarters where they disappointed investors. This more recent fourth quarter, they actually did quite well. They're doing a lot of internal improvements that they can take advantage from the growth in B2C shipping. They're getting much more cost efficient, and it's starting to be a positive lever point for UPS. We're very bullish on it going forward.
And then finally, you are constructive on CVR Partners. Now, this is a fertilizer company. It yields around 13%. Stock's essentially been fairly flat so far in 2016. So what's going to make this fertilizer company grow?
Well, we think that the total return just from the dividend alone of the company, which will more likely be in the high single digits, is attractive enough alone. They're very good as far as their cost position with the 2 fertilizer plants that they have. So we think even at cost curve type pricing within the nitrogen fertilizer market, they can generate substantial free cash flow. It was one of those baby out with the bathwater opportunities when MLPs were thrown out last year. Here's a company that's not even energy related. They're actually a consumer of energy that does quite well in the marketplace.
All right, well, thanks a lot for coming on and talking about them.
My pleasure.
And thank you for watching The Street.